Hey everyone, this will be your second lesson in the first module about understanding the stock market. Today, we'll be analyzing the market in terms of supply and demand. So here we have a supply and demand chart, and if you have no idea what this chart is really about, please reference our first lesson under the supply and demand tab, which will tell you all about it. So today, we'll be analyzing this graph in terms of resistance and support levels. So what exactly are resistance and support levels? Well, first of all, a support level is the lowest price in which sellers are willing to sell at. That's represented by my cursor right here, this red line. That's our support level. As you can see, the price continuously bounces off this level and moves back up. Conversely, we have a resistance level. Resistance level is the highest price which buyers are willing to buy at. And that's represented by this line up here, which the price, when it goes up, it bounces off the resistance level and it comes back down. So as you can notice, the price is fluctuating between our resistance and support levels, and this concept can help us predict where the price will be based on these two levels. So if you look at a supply and demand chart, you can see where the resistance and support levels are. The support level is essentially where the supply curve intersects with the y-axis, and where the demand curve intersects with the y-axis is a resistance level. Now, if we're given a specific price, such as $42.50, we can see that there are 25 sellers and 10 buyers. This means there'll be 15 sellers who will be holding a stock in which they want to sell. The result of this will be a drive down in the price to reach equilibrium, because basically the seller will continuously lower their price, allowing more buyers to purchase the stock until they both achieve the equilibrium level. So the supply and demand curves here can shift, and they can change the resistance and support levels. So the stock market, as we know, reflects investors' expectations about the future of certain companies, commodities, or other financial products. In our last video, we noticed how the expectations of sellers and buyers are shifters of these curves. And this type of shifter is what we'll be analyzing today. So if we want demand to increase, if demand increases, it will shift right or upwards, which increases the market price. One example of this is with Gilead, which is a drug company, who have the ticker symbol of GILD, when they came out with the news of their COVID-19 drug success. So, as we see here, Gilead had a support level around $61 and a resistance level around $67. However, around this time period right here, when we received the news of their drug success, we saw a huge spike. And this is basically a result of the increase in the demand curve, because more people wanted to get in on the rise of the stock because they saw potential in it. Conversely, a demand decrease will shift our demand curve left or downwards, decreasing market prices. An example of this can be seen with Delta Airlines with the ticker symbol of DAL. Here, as you can see, we have a clear support level around $50, around $52, and a resistance level around $62. However, with the COVID-19 pandemic, around this time right here, we saw a huge sell-off, and that was mainly due to people who didn't really see the future in the profit or the growth of these airline companies because of the airline cancellations and such. So this decrease in price, that decrease in price is basically represented by that leftward shift of the demand curve. Now, onto the supply curve. So if our supply curve increases, we'll basically be decreasing market prices. And an example of this would be with oil, with the ticker symbol of USO. So initially, this oil stock had a support level around $85 and a resistance level around $107. But it quickly sold off around this time period, and this time period right here was essentially when the Russia and Saudi Arabia were fighting for market share in the oil industry, and as a result they were outputting large sums of oil, and these large amounts of oil shifted the supply curve rightwards and decreased the price. And you can see that in this huge sell-off right here. Now, an example with the supply decrease, which results in increase of market prices, can be seen with the latter half of the COVID-19 pandemic so far, meaning around April or end of March time. If we take a look at SPY, which is essentially an ETF representing a whole bunch of stocks, and a lot of times we use this ticker symbol SPY to represent the overall market, you can see around this time in March, there was an increase in prices. This is largely due to the Federal Reserve, but another motivator for this price increase was that supply decreased. Because if you look at this huge sell-off, right? This huge sell-off occurred and people wanted to get out of the market because they didn't want it to go any lower. So less and less people were involved in the stock. So supply decreased and drove the price up, which supported this rise right here as you see here.